If you're looking to beat the market and grow your wealth and income long term, dividend stocks are clearly one really great way of doing that. Now, this is a company, Teleperformance. It's domiciled in France. My name is Lincoln Wood. I'm a business school professor in New Zealand. And what I do in my teaching and my research is I'm often looking at what operationally creates the most competitive companies, what gives them advantages that other companies cannot assail. And I use what I learn from research and what I learn through my teaching and preparing for teaching to help me pick great stocks and great investments to become a shareholder in companies that I believe have long term success. Now, this is a company, Teleperformance, that does, in my mind, have the ability to grow. Now, since the pandemic, we can see this orange line here is representing the adjusted or the operating earnings. And it's been a little bit bumpier than I'd like, but we can sort of see fundamentally it's been growing year on, year out. And it looks like it's sort of been growing at this 10 to 20% in terms of the earnings per year on average, with estimated earnings growth of about 8% for 2025 and 2026. Now, this is double B rated, so it's not as strong as most of the companies I like to invest in. And we can see the current dividend yield is 4 and 0.45, so about 4.5% is the current dividend yield. And we can see here that the dividends have been sort of holding constant or increasing at quite a good rate over time. Now, this orange line is, as I said, just the representation here of the earnings growth. And the white line here is a representation of the dividend payouts, the dividend rates that are being paid. Now, if I add this black line on here, we can see the prices got a little bit, in my mind, a little bit crazy. So post-pandemic, prices got up to sort of 40 times on a price to earnings multiple. And now we can see in a live estimate they're at about 5.8 times down here. So a sort of a big disconnect between the actual price going down from 2021 to 2024. And in 2024, earnings have actually jumped up 50%. Now, a lot of this is through to fairly large and sizable acquisitions, and that is definitely something that I'm going to talk about in future videos. But my basic thinking here, as I look at this company, is this big disconnect. Now, this is by no means what I would consider to be a slam dunk, and I'm building this position up a little bit here, and as prices go down, I'm adding to this position a little bit. And one of the reasons I don't consider it to be a big slam dunk are the analyst scorecards here. It's not as pristine or as good or as easy to estimate as I like to see. As I said, the analyst estimates are not as pristine or as good really for Teleperformance as I would like to see. We can see here in the 1 year forward, primarily the analysts get it right when estimating the adjusted earnings more than half the time, but there's also some reasonable proportion of misses here at about 1/3. Now, estimating the earnings 2 years out, analysts are doing a better job, but there's still a reasonable proportion here, in my mind, of cases where they've missed. Now, if we switch this to the 2 year chart here, we can see in the past they have got it right. Company has beat the analyst expectations here in 2015. Got it right. A bit of a blip here in 2020 and a bit of a blip here in 2023. So it seems to be getting more tricky for the analysts to get the right estimate here. And so for me, it's not a black mark in terms of the analyst estimates, but it's certainly something that I am keeping a half eye on to ensure that I can still have some confidence in this. Now, in terms of what's going on here, as we look through here, we can see over the last 6 months, the analyst estimates have been sort of downgraded for 2023, so it dropped down quite a bit. And as we can see here in black, the prices have followed that drop in estimates. But what I see here in the last 6 months is analyst estimates have been fairly consistent with some very, very small revisions downward here, with some good single-digit earnings growth estimated here for 25 and 26. I can also, in fast graph, switch this back to what it looked like 6 months ago, 3 months ago, previous estimates and the current estimates, and we can see that the lines don't change too much, although they do change a little bit. Now, the current price to earnings ratio is 6, and I'm going to talk a little bit about why that might be and what that means in terms of opportunities and risks. Now, at a normal multiple here, it's traded at very rich multiples in the past, and if we take this back to a reasonable multiple here, so over the last year, it's traded about a 16.8 multiple. We could be looking at some fairly good returns if prices return to these higher levels relative to the estimated earnings in the future, with it potentially here to the end of 26 a 250% total rate of return, which translates into incredibly strong 80% per annum. Will this happen? And I have no idea. But what I do know is that at 4% dividend yield, the dividends themselves, after, say, a 10-year period, would recover 40% of my investment cost, which gives me some sort of downside protection and some ability to sit here and wait for an improvement in the prices for, say, 10 years. So even if it goes sideways with a dividend yield of about 4%, I can sit happy on this investment waiting for the prices to return. Now, another interesting point here is the long-term growth estimates. Now, this is only provided by 2 analysts, so you need to take it with a grain of salt. And they're estimating about a 6.5% increase in earnings per annum, sort of for a 5-year period. Now, if we took here at a 15 times ratio, which is, I think, very reasonable for a company that grows at this type of rate, we're talking about still a reasonable potential rate of return here of about 20% per annum, which comprises the 4% dividend yield plus some price appreciation. When we think about Teleperformance, we are thinking about a company here which is a globally recognized leader in business process outsourcing. Now, as you can see here as well, that they advertise themselves as having a lot of great job opportunities for workers. And this is a global company. So they've got operations across the world, Americas, Europe, Middle East, Africa, Asia Pacific, as well as, of course, within India. Now, their main focus here is actually on customer experience management. Now, they've got this massive range of different organization types that they work with, and a big range of different industry-specific offerings, as well as major service offerings. Now, in terms of their core services, they offer technical support, customer acquisition, but they've also got specialized services as well. And their specialized services really focus on analytics, digital integrated business services, as well as language services. Now, when we begin to think about this diversification enables them to really operate in several quite different market segments. And when we think about this, they have through this the ability to, I think, be fairly robust and fairly stable. Now, as an organization, they've got over 45 years of experience over a range of different industries: technology, retail, financial services, healthcare, for example. They do a lot of work integrating data and artificial intelligence within their services as well to improve efficiency and service quality. They've got partnerships with large corporations such as Microsoft, and by really wrapping a lot of the AI within their services, they're actually able, I think, to do a really good job of offering their clients better value and better opportunities for growth. Now, they are one of the largest global BPO, business process outsourcing companies, and I think this economies of scale is really advantageous to them. And they're able to do a really good job and leverage this. And it creates it difficult for smaller competitors to come in um, and compete with Teleperformance. Now, when we begin to think about the services that they offer, we can look through here and we can see there's a huge amount of different services. Now, what this means is that once a client begins to work with Teleperformance, there essentially becomes a very high switching cost. Now, this is, for me, strategically an important point because if a client is locked into this range of services, essentially, and it's expensive or tricky or difficult for the client to leave to a competitor of Teleperformance, then it means that these long-term contracts, this massive, really deep integration within the client operations is going to make it very tricky for that client to leave. Now, and for Teleperformance, in my mind, that gives them a huge advantage over other companies in this space. Now, I think there's been some concern over artificial intelligence. I see their integration of artificial intelligence as a really big benefit for them. It should enable them to continue to help and support clients to do a better job, to become more efficient and expand the services that they offer. And I think that's really important. Um, I think there's still quite a lot of opportunity here for much more expansion within some of these specialized services, as well as consulting, analytics, and technology. The specialized services here as well is also going to be the higher margin service offerings, and they've also experienced good double-digit organic growth, which we'll get into a little bit later. They've got fantastic free cash flow generation as well. And we can see that as we also look back at fast graphs. If we look at the historical tab here and we begin to look at the free cash flow growth, it is just monstrous how much that free cash flow growth is growing. And now I've got the price off here. We can see that the price sort of tracked the free cash flow growth for quite a while, and then the prices have taken this big dip down. But the free cash flow growth for me is a big attractor as an investor here. Now, another thing that I absolutely love is their ability to operate globally. So they've got a number of clients around the globe and in pretty much every region of the world. All right. So I'm looking at the Teleperformance quarterly information for the end of September. So this is the end of Q3. Now, as we scroll through, there's a couple of things here to really take note of. Number one is the major rail integration. Now, I think this is one of the core issues that many of the stock investors have been concerned about. And I'll talk a bit more about that later. And they talk here about a stronger governance structure. And again, we will come back to that later. What I want to do, though, is skip down through here and just highlight a few of the issues and opportunities that I've already talked about. So the business performance by activity, we can see the specialized services that I talked about are 15%, whereas the core services here are about 85%. Now, the specialized services are growing really, really well with double-digit growth. And this is also another important part here in terms of their opportunities for growth is the cross-company selling synergy. So clients are basically seeing that Teleperformance can help them and support them, and as a result, they basically sign up for and pay for more of the services that Teleperformance offers. The core services have relatively low sort of single-digit growth. They talk about strong momentum here, for example, but they haven't provided any figures, so I think we need to take that with a bit of a grain of salt there. We can see as well that the verticals that they operate over are quite varied, so they're not sort of exposed to a single sector which might be affected, say, by regulations or changes in globalized trade patterns so much. So they've got a really good diversified client portfolio here. Now, the the performance by business line is good. So care here is obviously a very big component, and the specialized services, as we know, are growing really well. Now, if we scroll back to some of these issues here, and I think this is really the what's going on, and what many of the investors are focusing on here is probably this major L integration. Now, when we begin to think this through, they say it's been proceeding in line with expectations. Such a large integration is always going to be fraught, but they seem to be implying through what I've been able to read that they're achieving the cost synergies they were looking for. It's obviously boosted revenue growth quite a bit, and it's also overall enhanced their ability to provide more and better services. So what's going on here? Well, there's some obvious risks here. I mean, any major integration, such as with Major L, does have risks, and I don't think they've finished or fully out of the woods yet. I don't think this integration is beyond the point of risks at this point. One of the challenges that they have had is this issue here, and they note a stronger governance structure, which very much implies the issues with governance that they have had in the past. And there's been a lot of talk in the investor community about the governance practices previously. And the big challenges here, I think, in terms of the governance, it's been an interesting couple of years. So in August, so just before this September update, in August, they did announce some pretty big changes around the governance. So Mr. Singh departed as co-CEO to, quote, pursue other opportunities. And this is a very short tenure for a co-CEO. So when somebody comes on board as a co-CEO and then they're leaving fairly soon after, that does raise some interesting questions for investors and other stakeholders as well. Now, what we see here is we see Mr. Alan Alalami was appointed as the new chairman. He was the founder of the Saham Group and was appointed as the chairman of the board, and Mr. Mackenbrock was appointed as the group deputy CEO. Now, this is also important because Mr. Mackenbrock was the former CEO of Major L, and so they're bringing the people, the very successful people from Major L into Teleperformance in a major way. And the expectation here, at least from what I can see, is that Mackenbrock will soon become the CEO in the future. So why is this important, and what does this mean for investors? Well, I think this is a huge benefit to investors because the key issue here is that they brought on new leadership, and I think that should improve some of the corporate governance here. It enables Teleperformance, I think, to turn a leaf on some of the issues that they were having previously, with CEOs entering and exiting in very short periods of time. So I think there's some positive improvements here, but it does enhance some of the risks to the company. Now, by placing Alalami and Mackenbrock here as key leaders within the organization, it's going to enable better oversight by some of the primary shareholders. So Alalami was the founder of the Saham Group, and they were a major shareholder within Major L. So by having one of the Major L shareholders essentially represented as the chair or the governance board here, I think that really does a good job of demonstrating that the shareholders are taking a very strong interest in the governance over the company, as well as really helping to align the expectations of the shareholders with the day-to-day operations of the organization. So I think this is going to, in the long term, lead to much better oversight by some of the primary shareholders um, over the operations of Teleperformance, and I think it makes a substantial improvement in the alignment of the company activities with shareholder interests. So fundamentally, I'm very excited about this change in governance, and I think it's going to be very positive, although it may take several years for the benefits to be fully unlocked. Now, what else is an issue here? So obviously, when we think about this, there's a lot of different challenges and difficulties that the company could face. So even if we look at this slide, for example, BPO, business process outsourcing, it is a very competitive global industry. So it is possible some of their competitors might poach key clients. There have been questions around, I think, some of the employment practices within different parts of the world. And I think there's been some regulatory risk around that as well. But look, I think they've got a good balance sheet. They've got a triple B credit rating from S&P Global. They've got great market opportunities globally. They've got some really good high margin, high growth specialized services. And so I think, long term, yes, there are risks here, but I think Teleperformance is in a very good position and trading at 6 times price to earnings with over 4% dividend yield. For me, this is a substantial individual stock position now within the family portfolio. It's not the biggest individual stock position, but I think I've got it up to about the size that I feel comfortable with, maintaining it at this position and waiting, even if it takes several years, to unlock some of that value that we were talking about.